Hi, my name is Vincent Scarsella, Head of Research and Investment Development here at Sgroi Financial, and welcome to Market Moves. In today's segment, we will be reviewing what happened in 2023 and also what opportunities lie ahead in 2024. Markets were on edge in 2023 as stocks just suffered their worst year since 2008. Bonds had their worst year in history, facing recession fears, inflation, rising interest rates, falling earnings, and the Ukraine war. The Federal Reserve's ongoing tightening of monetary policy once again was supposed to roil stocks and bonds. Many analysts predicted another dismal year for the markets, but stocks began to rise and then rise some more. By early February, the S&P 500 was off to one of its best starts in history. In March, both Silicon Valley Bank and Signature Bank were shut down as depositors raced for the exits, attempting to withdraw $42 billion from SVB in one single day. The Treasury, Federal Reserve, and FDIC came to the rescue, effectively backstopping losses and calming investors' nerves. After giving up nearly all of the gains for the year, the S&P 500 would bottom just 3 days after SVB failed and never really looked back. Stocks then spent most of the first 6 months of the year marching higher, as falling inflation and resilient economic growth prompted a risk-on appetite by investors. The main driver of this was the enthusiasm over AI, which helped mega-cap technology rally and the broader market along with it. The Fed continued to tighten and increase rates by 1% during the year. This brought the total spike in rates from 2022 and 2023 up to 5.25%. The largest two-year increase since 1979 and 1980. This caused some volatility into November, and then markets learned inflation fell more than expected, and the Fed held rates steady. In December, Fed Chair Jerome Powell spoke and projected 3 rate cuts were coming in 2024, which helped stocks and bonds rally into the end of the year. When all was said and done, the Dow Jones logged a 16.2% gain, the S&P gained 26.3%, the NASDAQ blazed higher by 44.7%, which was its best year since 1999, and small caps rose 16.9%. After a tough 2022, which saw both stocks and bonds down double digits for the first time ever, markets responded well in 2023. The S&P 500 gained 26.3%, while the NASDAQ soared, up 44.64% for its best year since 1999. The blue chip Dow Jones was up a nice 16.18% for 2023. Small caps, as represented by the Russell 2000, were up 16.93% in 2023. The stock market ended with a bang in 2023 after Fed Chair Jerome Powell spoke in December and implied rate cuts were coming in 2024. All indices soared. Small caps rose over 12% for the month, while the tech-heavy NASDAQ rose 5.6%. The Dow and S&P each gained 4.9% and 4.5% respectively. December was also a great month for value stocks. Growth was in vogue for most of the year, but in December, we saw a broadening of market breadth. The large cap value index was up 5.55%, while large cap growth was up 4.44%. For the year, it was a different story, as 7 stocks carried the growth index and the S&P 500 as a whole. Large cap growth was up almost 43% for the year, while value was up 11.36%. From a sector point of view, the more sensitive areas to the economy outperformed by a large margin over the more defensive areas, as investors sought out the high-flying technology names as AI powered the market through most of the year. Technology, communication services, and consumer discretionary led the way, up 56%, 53%, and 40% respectively. Energy, consumer staples, and utilities lagged behind the broader market as they were down 0.64%, 0.83%, and 7.17%. Turning to fixed income, bonds were perhaps the biggest beneficiaries of Powell's December speech. Longer duration bonds, which are heavily influenced by interest rate movements, were up almost 8.7% in December, while the Barclays Aggregate Bond Index was up 3.7%. For the year, the AG was up 5.65%, while longer duration bonds, as represented by 20-plus year bonds, were up 2.7% total return. 2023 was characterized by forecasted interest rate expectations by market participants. After perhaps the most aggressive Fed tightening by Powell, economic data and inflation started to trend down, which helped the market rebound. The U.S. inflation rate continued its year-over-year slide, falling to 3.14% in November, which is the lowest print in 5 months. Core inflation slowed to 4.01%, its lowest year-over-year level since September of 2021. The monthly consumer price index inched 0.1% higher, and monthly U.S. personal spending grew 0.25%. Housing, which is perhaps the first area of the economy that sees pressure with rising rates, saw new single-family home sales plummet 12.2% month over month in November, while U.S. existing home sales inched 0.8% higher. The median sales price of existing homes fell for the 5th straight month to $387,600 in November, which is 6.33% below its all-time high. As we do start the new year, economic data in 2024 must be viewed in the context of a market that is very aggressively pricing in Fed rate cuts starting most likely in March, and a market that is pricing in essentially zero chance of a significant economic slowdown. As we do head into 2024, there are a couple things that we will be looking at very attentively. The first being the Fed. The market is pricing in the Fed to cut rates 6 times, and the main reason the market did rally in the fourth quarter was due to the assumption the Fed was done with hikes and cuts would be coming early in 2024. The second point, no economic slowdown. The market is priced in for a soft landing with no economic slowdown. Investors expect growth to remain resilient here in the U.S. and inflation to decline. Third, solid earnings growth. Markets are expecting above average earnings growth for the S&P 500, which would help further gains. Consensus has earnings per share mostly between $245 and $250 a share. This is nearly 10% higher than the currently expected $225 a share in 2023. This would mean very strong annual corporate earnings growth. Next point, no additional geopolitical turmoil. The market is assuming no escalation in the Russia-Ukraine war and the Israel-Hamas conflict. If the market did believe that we would see any escalation, oil prices would be higher than where they are trading at currently. If oil prices do start to trend higher and get above $100 a barrel, then that would reflect real worry. Lastly, no domestic political chaos. 2024 is an election year, and there has been no long-term compromise on the funding of the U.S. government, so shutdown scares do remain. Thank you for joining us on this edition of Market Moves. If you have any questions, please do not hesitate to give Sgroi Financial a call.